Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over some market conditions and also some ratios that I follow. We'll look at a bunch of precious metals and other commodity ETF, well, commodities I should say, and Dow Jones, stocks versus commodities, all those types of ratios. And we'll look at the consumer price index. We'll look at some inflation data and PPI, CPI ratio, stuff like that, just to see what the market conditions are looking like, what's going on in the markets from a charting perspective. And obviously, I'm going to give my financial opinions around all of this. If you guys need any help with anything, definitely check out finding-value.com. Become a platinum member. Use the word discount, the coupon code. We got a Discord channel that we can chat back and forth, share ideas from, in the community, member to member, whatever it is. We also have midweek updates and weekend question and answer sessions. All right, so let's dive in. Let's see what we got here and how these things are moving. So this is the United States Consumer Price Index just charted out. And you can see these were the expansion phases of real estate. They have a little bit higher CPI. They kind of go a little bit more vertical during those periods, but pretty much it's a left to right type movement. If I were to put, like the rate of trend, you can see that this is kind of flat. And then this guy's got a little bit more higher rate of trend. And then it looks like that rate of trend is accelerating upward. That could also be from the exponential ways of a credit system. Basically, how money systems are designed and work. They start out relatively flat, and then they increase in intensity, the trend. It increases upward more vertically over time as the debt becomes unsustainable. We do have some periods where we had a little bit of a collapse here. That was the 2008 collapse, and that was created by currency basically being destroyed or credit being destroyed in the system. But right now, it's looking pretty strong here, guys. It's looking pretty strong. We look at United States housing starts. Housing starts were up last month, not March, but the month before that, February. They usually get released, the data, around the middle of the month. But so far, is this area much like this area? I don't know. We'll find out. And I think it highly depends on what interest rates do. If they lower interest rates, I think this is going to run. If they keep interest rates where they're at, then I think it's going to kind of chop sideways, maybe even slightly lower. But that's housing starts, and that's kind of what we're looking at. The expansion phase kicked on here at the average, going above that average. This is a long-term United States inflation rate. So this is the rate. We've been coming on down, and we bonked our heads on a long-term resistance trend line for the inflation rate. Now, I know that the way that it was calculated back here is not like it was calculated, from this point on or so. So we did change the United States interest or the inflation rate year over year. But I do think this could potentially head higher at some point. Whenever they print money, we've got problems in the system from the supply side. It's going to hit the inflation. So in order for this system to survive, they're going to have to print money at some point. They're going to have to loosen up, get money into the system, reliquify the system, and it's just going to cause problems with inflation, I think. This is the PPI to CPI ratio. And what's different about this, I find this chart actually highly interesting. We had a gigantic kind of decline. We were kind of in a decline here. And yeah, we had a very strong impulse surge here. That was the 1970 onward all the way to the tip of 81. So we had a nice impulse surge higher here where real things outperformed financial assets, or where the PPI outperformed the CPI. This is inflationary when it goes up. So that was an inflationary kind of move in a larger downtrending fashion move. What we have here that's developed from 1986 is a big double bottom pattern with basically the top of that double bottom being up here. We have a bull market from 2000 to 2008 here. Yep. And then we had a bottom here in 2020. We rocketed higher. And if this is a first leg where we eventually break out into a third leg, this means that we are in a different paradigm. The world's going to feel different than it has for every single person who's lived before. And maybe this is wrong. I'm just kind of looking at the chart here. This world here means that we have scarcity, most likely. And will technology and AI and all this other stuff overcome the scarcity on Earth? I don't know. We'll find out at some point. But that's the PPI to CPI ratio. We have been in a disinflationary pullback right here. And I think that this is going to accelerate to the upside as soon as they touch the liquefy button or the printing button. And that's basically the only tool they've got. Let's go print a bunch of money. Either hold interest rates down with QE or and buy bonds, or print it and put it in banks or buy assets or whatever they do. But that's what that setup looks like. We've got active listings still incredibly low for real estate. That's less than 2 months. Incredibly low. We've got the M2 money supply versus GDP, and we can see that this has been falling the past ever since 2020, since they created all that money. But we basically were in, back in the 60s, 70s, 80s, in here, all the way to about 91, we were tracking sideways where we had a pretty balanced M2 money supply in relationship to gross domestic product. We had a little surge in productivity, what's going on in the 90s, where things got basically cheaper. GDP outpaced the M2 money supply. Then from about 97, it's been a disaster ongoing, where we've just printed currency at far faster paces than gross domestic product. We have a pullback in it here recently, but I don't know how long that's going to be sustaining. We also had a pullback in 17 to 2018, 19, where they had to reliquefy the whole system. Something went down there. But that's what it looks like right now. Generally speaking, this is inflationary. And I think that this is going to turn at some point, I don't know when, and be inflationary again. Gold to M2 money supply, we are incredibly cheap, and we're starting to move higher in this ratio. We can kind of put that on there, and it looks like it's ready to break out. We can zoom in on it. Yep, it's breaking out from this downtrend there. I didn't draw it perfectly, but I can draw it like this. So we have a breakout, a retest, and then we're starting to go higher where gold is going to outperform the M2 money supply. How does that happen? It means that the market conditions are ripe for gold to outperform other assets. And when those other assets, when gold starts to outperform those other assets, money starts to rotate into gold. And what will happen is more of the M2 money supply will go after gold under those market conditions, pushing this ratio higher. The market conditions that are ripe were just like the 1970s. Think of high energy prices, high inflation, a demographic coming into home buying years, and money rotated into gold and preferred gold over other financial assets. I think that's what's coming next, is another repricing of gold where the money rotates into gold and prefers those financial assets. This is total bank credit versus GDP. And we have these large outperformance periods of total bank credit from 1999 onward. That was the last commodity boom. We had a gigantic burst out of 2020. And then I think eventually this is going to work its way higher. This total bank credit divided by GDP basically looks like commodity charts all over the place. We've had large surges higher and then kind of doing retests back to the breakout level in this general area. So things like nickel look like this, things like copper, where they break big kind of resistance levels, and then we come back to the support levels, what we call it. But that's what that chart looks like. This is just total bank credit outpacing GDP. Let me see what this one is. We're not going to look at that one. So let's go to some of the ratios here. So this is just to see how they're doing as well. This is platinum versus gold. And we are still incredibly low at only 0.5. So 1 ounce of gold can buy 2 ounces of platinum. That is historically a incredibly good entry point. We get the Batman pattern, the double top, and we come down. We've broken the pattern to the upside here. We did a retest, and now we're just waiting for launch. Just waiting for launch. So platinum's the one that I would prefer over gold at this exact second. And gold is still good, guys. I'm not saying anything bad about gold. I'm huge bull on gold. Just saying platinum's cheap compared to gold. Platinum is cheap compared to palladium and is starting to outperform palladium to the upside. So that looks really good. It's only 0.7. So 1 ounce of platinum can only buy 0.7 palladium. That is incredibly cheap compared to history. Incredibly cheap. Platinum versus silver. This one's also favorable for platinum. We've got a descending kind of falling wedge. We've broken to the upside. Doing a little bit of a retest move before I think we're going to head higher. Is platinum actually going to outperform silver? We're going to find out. Silver, I think, is going to do incredibly well, which means I think platinum is going to do incredibly well. But platinum is incredibly cheap against silver at this time. Gold versus silver. I think silver is going to outperform gold. We are at a very cheap ratio for silver. We're at 81.7 is the most current ratio. What we did is we peaked out here. This was like incredibly cheap. This is anomaly cheap. This is blow off top cheap. It's a false breakout. We came back into more normal areas all the way down to 65. Came back up to do a retest to 96. Broke back down, did another retest, and now we are really compressing to the downside. We could see a huge outperformance of silver here doing it right now. That's what we're seeing, and we could see a continued outperformance. So that's also looking pretty good. Palladium versus silver. Palladium does pretty well in these disinflationary environments. We are not in a disinflationary environment. Even though we are, but we're in a larger picture inflationary environment. And this is also telling us we are in that type of environment. We're at 61, which is cheap for silver. And I think it's going to continue to go lower where silver will outperform palladium. Some of the lows, 15-ish, below 20 is a pretty good level to get to for a swap, anything below 20. Dow Jones Industrial Average versus gold. Big picture view. We are compressing. We had a little kind of move higher here. And then I think we're going to roll back over down to the downside where gold is going to outperform the Dow Jones Industrial Average. This is what it looks like here recently. We've had a good compression down here. We've come back up, and maybe this can come up a little bit more, but I think we'll compress over time. The fear in the markets are going to supersede, push this ratio lower, and you can kind of see we've got some sort of pattern there. And maybe it'll go up for a little bit in the short term. Looking for gold versus Dow Jones flipped. So when we flip this thing, it's a little bit easier to see a different pattern. You can see that this pattern is coming on down. We've broken out. We're probably doing a retest move. There's your retest move before heading higher. So it's another way to look at the Dow Jones to gold or gold to Dow Jones ratio, and showing you that maybe we're just doing a retest move before compressing even further. Gold to oil ratio, we went back to 30. That's an incredibly cheap level for oil. And now we're starting to compress back down. Will this trend continue? Well, let's hope. I mean, I'm pretty long oil, but yeah, that's what it looks like. If we were to look at kind of some of the other previous bull markets here, we don't see the beginning of the 2000s, but we compressed all the way down to 7. 1 ounce of gold buying 7 barrels of oil. And we're up here actually at a very cheap level of 26. That is still incredibly cheap. And I do think that this is going to compress all the way back down over time at some point. I also think gold will continue to move higher, which means that oil prices could do some crazy stuff over this next bull market. That's what we're seeing. Let me see this guy. Crude oil versus natural gas. Natural gas is incredibly cheap, 35 for a ratio. There it is from a long-term picture. It got to 48 once. This is a blow-off top. Came all the way back, compressed back down to about 15 down here. Now we're back at a very cheap level of 34.15 is what it currently is at. But that is incredibly cheap, guys. And I do think eventually this will compress back down over time as they shut wells in and the world switches more of its energy generation to natural gas from either coal or other things because natural gas is so cheap at the moment. It's way cheaper than crude. Crude oil versus gold, this is reversed. Sometimes when you reverse these ratios, they look a little bit different. This looks way different. This is the uptrend where crude oil was outperforming gold, gold outperforming crude oil, and then we've broken out where crude oil is going to outperform gold for a period of time. We're doing a retest move, and that's where we're at right now, and we're starting to come back higher, where recently crude oil is starting to outperform gold, and we could see that outperformance if we can break through kind of this trend line here. If we can break above that, I'm going to be incredibly happy, and I will look at gold a little bit differently. But that's the ratio there, looking fantastic for crude oil. Hopefully that momentum can continue and it doesn't hit its resistance area and roll back over. We'll watch that. This is crude oil versus the Dow Jones Industrial Average. Big picture view, we've got that double bottom that's basically forming. And if we look here, let me throw a trend line in here real quick, guys. You know, we could say that we've broken the trend here, did a return or retest move, and now we're breaking to the upside against the Dow Jones Industrial Average. I know a lot of people think that this is some sort of shoulder, head, shoulder with a neckline that runs across here. But I don't know. I think it might not be the case. We'll have to see. Crude oil is also incredibly cheap to gold, and gold looks like it wants to run higher. So I'm going to remain open, and I'm not going to really have a opinion on it till I see things start to break here. But yeah, this looks good to continue higher. We'll see if that happens. I don't know the future, but it definitely looks good for a move on up, where crude oil could outperform the Dow Jones. Dow Jones Industrial Average versus crude oil, so it's flipped back around just to see it. Last bull market, we can see this kind of created, it came up and then rolled over and compressed all the way down. It looks like the same type of pattern that this guy here is this guy here in this next bull market. And I've got this circle here where I think it's going to probably, hit. And we're in that circle right now, and maybe we can compress down where crude oil outperforms the Dow Jones from where we're at. Maybe that's all we get. Or maybe it comes all the way back to the top here. And we have one last kind of scare in the market where crude oil gets kind of a blow-off bottom out of it, like some of the technical analysis guys think. But I'm going to remain open. We'll see what happens. Either way, I'm good. Dow Jones Industrial Average versus natural gas. Natural gas is incredibly cheap. You can kind of see we're in this gigantic megaphone type pattern where the highs and lows are increasing over time against each other. And we are at a incredibly good time, I think, for natural gas for a very patient investor to be looking at natural gas. TLT versus gold ratio. Um, Gold has been outperforming TLT the entire time, basically. We had a little bit of a move higher here in this disinflationary period, and it looks like we're compressing back down. So that looks good for GOLD. Gold versus TLT reversed, just to show you guys what it looks like in the reverse. Natural gas versus Dow Jones Industrial Average. To me, this looks hugely bullish for natural gas. We have a compression, a breakout, and a retest. And this is probably going to go much, much higher in the future. So natural gas actually looks really good from this perspective here. And this could be putting in a bottom against a lot of different assets for natural gas. You could say also that this is a 1, 2, 3, 4, 5, 6, 7, and then we're going to break on up for a Livermore accumulation cylinder as well. Copper to gold ratio. When this goes down, generally there's more fear in the market than there is kind of that economic growth, which is the case. And this here is a flag pattern. And we've broken to the downside of this flag pattern, did a retest move, and I do think this could compress further downward, meaning that gold could outperform copper for a period of time, and there could be a fear or scare in the market for a period of time. And then I don't want to go over these because they don't look all that hot, but let's do Baltic Dry Index to gold. Baltic Dry Index to gold is still incredibly cheap. We had a period where Baltic Dry Index outperformed gold. We had a period where we had a double top. We came down into the valley of just getting crushed. Went sideways. We're still in that period of getting crushed. And hopefully this can come back up over time where we see an outperformance of the Baltic Dry Index versus gold. And I don't know if we will. I mean, we'll see. We'll see what happens there. We're going to have to produce more commodities, and it makes sense that the Baltic Dry Index would outperform gold for a period of time. But that's what I've got for today, guys. It's all I've got. A bunch of different ratios there. The most compelling one and the cheapest is probably natural gas. That is super cheap. Crude oil is also cheap, and natural gas is cheap to crude oil. So I like those two. I think they're very cheap in relationship to a bunch of different assets. They also look very good against other assets, and so does gold and silver and platinum. Platinum's also the cheapest precious metal in terms of ratios compared to history. But that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you guys like. And we'll catch you later. This is Finding Value.